Hello and welcome to the lecture for Chapter 13. I've really been looking forward to this chapter because I think this is kind of where the rubber meets the road in a lot of ways. This is how you take accounting information and your understanding of how costs behave and translate that into actually making decisions for a business. So I'm going to start out by talking about characteristics of relevant information, so some kind of definitions and ways of looking at things. And then I'll talk about four very common types of decisions that have to be made in businesses. Do we accept an order at a lower price? Do we outsource what we're currently making or vice versa? Should we eliminate a segment of our business like a product line or a division? And then when should we replace an asset, like trade in the truck on a new truck, that sort of thing. So again, to start off with, we'll talk about characteristics. So the key thing there is to focus on information that varies between the two or more alternatives that you're looking at. Anything that's not going to change, say you're choosing among one of three different product lines to promote, well, the rent on your offices doesn't change depending upon which option you choose. So ignore the costs that are not going to change and focus just on what is going to change in the future. Sunk costs are costs that you've already spent and can't be undone. So as an example, if I bought a one-of-a-kind specialty machine for $100,000, it was only good for one purpose, and now I'm later trying to decide if I should stay in the business for which I purchased that machine, okay? Well, whether I should stay in that business or not is not dependent on what I spent for the machine. That's done, gone. Any decision I make in the future isn't going to undo that impact in the past. So sunk costs can be ignored when it comes to what we should do in the future. Opportunity costs are the sacrifice or the benefits you forego by choosing one particular option. Let's say as an example, you have a large warehouse, so you don't need all of it, so you rent out a quarter of it for $10,000 a month. Now, if you're deciding on a new product line that's going to require you to use that part of the warehouse for this new product line, then an opportunity cost is the $10,000 a month you won't get in rent if you choose that option. So it's important when you make decisions to keep in mind that, well, we're going to focus on quantitative aspects like how do costs change under different scenarios. It's important to recognize that qualitative information is important as well. As an example, if you're trying to decide if you should drop a product line, you may find that that product line is pulling your company down financially, that there is negative contribution margin for that product line. We'll come to that later. And so you may decide purely on quantitative terms that it should be dropped, but it could be that the products in that product line are really critical to your biggest customer. And if you didn't have those products, you'd lose that customer. So those are kind of qualitative considerations that also need to be taken into account. Differential revenue is the difference in revenue between two alternatives, and differential cost or expense is the same thing for cost and expenses. And again, that's our focus when we look at two scenarios. An avoidable cost is a cost that if you choose a particular alternative, you avoid having to pay that particular cost. First of the scenarios I want to talk about are special order decisions, and this comes up all the time in business. Oftentimes you'll get an order that'll just come out of the blue from another country in which you don't even do business, and they'll say, we'd like to buy a whole container of X, and they offer to pay some lower price than what you're selling domestically. So the decision is, should you take the order or not take the order? Well, first and foremost, if you have to be very careful from a communication standpoint that if you do take an order at a lower price that your existing customers don't find out about that. So it has to truly be a unique one-off outside of your normal market kind of an opportunity, or it can undermine you getting that same, your higher price from your existing customers. The other thing is you have to have capacity. So you have to have capacity within your factory, within your workforce, where the only thing you're going to incur if you produce more of that product is variable cost, that it's not going to increase your fixed cost. So in this case here, we have a company that has a monthly capacity in their factory of making 12,500 basketballs. Their currently monthly sales are 10,000 basketballs, so they've got some slack there. The normal selling price is $30 per basketball, and they've got $12.50 of variable costs and $7.50 of fixed costs when they allocate it to that 10,000 monthly sales figure. They receive an offer to sell 5,000 basketballs at $18 each, so that's well below their $30 normal price. So should they take that? Yes or no is the question. Well, to answer that, we'd look at the two alternatives. So we can either accept the order or reject the order. If we reject the order, our differential revenue, the change in revenue is zero, change in cost is zero. If we accept the order, our differential revenue is $90,000. That's 5,000 basketballs at $18 a piece. And our variable costs will increase. That's 5,000 basketballs times $12.50 per unit, 62,500. So I can see here that my income will increase by 27,500 for taking this order at a lower price. So the key thing there is if you have capacity, and if the action would not undermine your ability to get your price with your existing customers, then as long as the offer yields a positive contribution margin, it is worth taking the order. If it produces a negative contribution margin, then you're better off declining the order regardless of how much you want the business. The next decision is outsourcing. A lot of books will call this make or buy. Do I make the product myself or do I just buy it from somebody else? So that's an important decision. It happens in all kinds of businesses for either services that they do within their own company versus having someone else do that service, maybe managing the employee benefits function or something like that. Or it deals in a factory where should I make something myself or should I buy it from someone else? I dealt with this in my business a lot. So in this scenario here, a part is currently being purchased for $240 per unit. We have excess factory capacity, so that isn't an issue. And we can manufacture the part in-house for $80 direct material, $80 direct labor, variable factory overhead, and its allocation of fixed factory overhead would be $68. So a lot of companies would look at that and say $280 to make it internally, $240 to buy it from somebody else. Let's buy it from somebody else. The problem with doing that is it ignores that some of that overhead is fixed. And so by not making this internally, I'm just going to spread that overhead on other parts. So it's not going to save me any money. So again, differential analysis. So if I make the panels, I have zero purchase price to worry about, and I have the following costs there. If I make the panels, or if I buy them, I'll have the purchase price. I'm still going to have the fixed factory overhead. I'm still going to allocate overhead to those panels. So whether I make them internally or buy them from someone else. So I can see here that it is more expensive to buy the panels than it is to make them ourselves. The key thing here is to compare the variable cost with what it costs to buy from somebody else and leave the analysis at that level. The next slide is about segment elimination. So this company has 3 different product lines. And one thing that's important for you as you become managers in the future, after you graduate, to keep in mind that any reasonable managerial accountant should be able to produce something like this, an income statement by product or by product line. That is something that can definitely be done, and it's important to have that information. So this company did that with their 3 types of cereal: Corn Flakes, Toasted Flakes, and Bran Flakes. And if you were the CEO, you'd look at this and say, well, that's an $11,000 loss from Bran Flakes. Maybe we should get rid of Bran Flakes. So how to do that? Well, again, we'll compare the scenario. Do we keep the product or do we get rid of the product? Those are the 2 scenarios. One thing I want to point out here, I'd like to point out that their sales are $100,000 for Bran Flakes. Variable costs are 60 plus 25, 85. So Bran Flakes has a contribution margin. If this financial statement was in that format, you'd see that Bran Flakes has a contribution margin of 15,000. So keep that in mind. So we look at the 2 scenarios. If we continue with Bran Flakes, we'll incur $100,000 of revenue. Earn that. We'll have costs of $85,000 and $26,000, so we have that loss of $11,000 we saw earlier. If we discontinue the Bran Flakes, we'll have 0 in revenue. We'll have 0 in variable cost. We're still going to have that $26,000 a fixed cost. That's a portion of the president's salary, a portion of the office rent, all of that kind of stuff. It's the allocation to that particular product. So you can see here we're far worse off by discontinuing the brand flakes than if we continue with them. Notice the difference between those two alternatives is 15,000. So that's not coincidental. The difference is always going to be the contribution margin that you lack if you get rid of that particular product. So the key to this is if you have a product that appears unprofitable with its allocation of fixed cost, then you should certainly pay some attention to that and look into the causes. Can we increase our prices? Can we reduce our cost? It bears examination. But the key thing is to remember that if you have a positive contribution margin, you should never discontinue that product line. If the contribution margin is negative, then by all means you should. So the last thing I want to talk about is asset replacement. So oftentimes a company will have a truck that they've been using and they're making a lot of repairs to it, and they're trying to decide, should we pull the plug and get a new truck, or should we stick with this existing truck? So that's what this kind of question deals with. So this company here has an old machine that they've been using. So it has a book value of $100,000. That's what it's on our balance sheet at. And again, that's a sunk cost. So our decision as to whether or not we get rid of this machine or keep it, that $100,000 is moot. That we don't need to know that. The estimated annual variable manufacturing costs of the direct labor and maintaining the machine, $225,000. If we sold the old machine, we would get $25,000, and we think it'll last us another 5 years. So if we get a new machine, we're going to have to spend $250,000 to buy the machine. Its annual estimated variable manufacturing costs are much lower at $150,000. So maybe there's some robotics involved or something that saves us labor, or there's definitely less maintenance costs associated with it because it's new. It has a residual value of 0 and also an estimated useful life of 5 years. So again, as you can imagine, we want to look at two scenarios, two alternatives, and see what the difference is. So in this case here, if we continue with the old machine, then we'll get no proceeds from selling the old machine. We'll also have no purchase price to incur if we continue with the old machine. And our cost over the 5-year period we think the machine is going to last is $1,125,000. So that's the outflow associated with keeping the old machine. If we replace the old machine, we'll get $25,000 for selling it. We'll be out of pocket the $250,000 for buying the new machine, and we'll be out of pocket $750,000 for variable manufacturing costs like direct labor and maintenance on the machine. So that's much less. So now I can see I've got $25,000 coming in, $1 million going out, so my net outflow is $975,000. So in this scenario, based on these assumptions, I would be better off by $150,000 if I replace the old machine. So hopefully you found this helpful. I will look forward to talking to you when I lecture for Chapter 14. Thank you.